If you have $1 million IRA and you're planning to pay your Roth conversion taxes from your brokerage account, you might be making a $100,000 mistake. Not because the conversion is wrong, because of how you pay for it. The standard advice has been around for years. Pay your taxes from outside the IRA. Keep the full amount in the Roth. Let it compound tax-free. That part is true. But the advice stops there, and that's the problem. What most financial content skips is what happens on the other side of that transaction. When you sell appreciated assets from your brokerage account to cover the tax bill, you're not just writing a check to the IRS. You're also giving up every dollar of future growth on those shares. You're potentially handing your heirs a smaller inheritance. And if you live in a state like California, you may be paying capital gains taxes at ordinary income rates, which can wipe out the entire rate advantage you thought you had. This video is about that hidden cost. I want to show you the numbers that most advisors skip when they give the pay from outside recommendation, and walk you through a smarter way to look at your whole picture, not just this year's tax bill. Because for IRA millionaires with appreciated assets in a taxable account, doing this the standard way can cost more than doing it the other way. Sometimes a lot more. Let's start with the numbers. On a $200,000 Roth conversion in the 22% federal bracket, your tax bill is $44,000. The standard advice says, don't let the IRA custodian withhold that $44,000. Pay it from your taxable brokerage account instead. That way, the full $200,000 lands in the Roth and compounds tax-free. The math behind this logic is real. If you pay from your brokerage account and you're in the 15% long-term capital gains bracket, the tax cost of selling appreciated shares to raise that $44,000 might be around $5,610, assuming roughly a 15% cost basis on what you sell. Compare that to the 22% ordinary income tax you'd owe if the IRA withheld it, and the rate difference saves you roughly $8,390 in taxes. That's the case for paying from outside. But there's a condition buried in that logic. It assumes you're selling shares with a relatively low gain, or cash sitting in a money market. That assumption is where the advice breaks down for a lot of people with million-dollar IRAs. If you're like most of my clients, you've been told to pay from outside without anyone asking what's actually in that account. And what's often in that account is stock you've held for 10, 15, 20 years. Stock that's worth 3 or 4 times what you paid for it. When you sell to cover the tax bill, you realize a large capital gain. You hand a portion of it to the IRS, and the rest of the shares are gone. Every dollar of future growth on those shares gone too. So the question isn't just, what's the tax rate difference? The question is, what are you actually selling, and what does it cost you to sell it? There's also a second layer most people overlook: state taxes. In states like California, capital gains aren't taxed at a favorable rate. They're taxed as ordinary income, up to 13.3%. When you add that to the federal rate, the rate advantage of paying from outside can disappear entirely. If you have a sizable IRA and you're trying to figure out the right conversion strategy, stick around. Subscribe so you don't miss the breakdown of what this actually costs over time. Most people analyzing this problem compare two numbers: the ordinary income tax rate versus the long-term capital gains rate. If your rate on the conversion is 22% and your rate on capital gains is 15%, paying from outside looks like the winner. That comparison is real, but it's incomplete. The better question is this: in 20 years, what does your entire portfolio look like, including what you leave behind for your family? Let me run the numbers on a concrete example using 2 scenarios. In scenario A, you pay from your taxable account. You sell $44,000 of appreciated stock, shares you've held a long time, with a cost basis of about 15% of the current value. The gain on those shares is about $37,400, so the capital gains tax is $5,610. That covers part of the IRS bill. The full $200,000 lands in the Roth. After 20 years at 7% annual growth, that Roth is worth about $774,000. Your taxable account is now empty. Your heirs receive $774,000 tax-free. In Scenario B, the IRA custodian withholds the $44,000 for taxes. Only $156,000 lands in the Roth. After 20 years at the same 7% growth rate, that Roth is worth about $603,000. But the $44,000 of stock you didn't sell? It's still sitting in your taxable account. At 7% over 20 years, it grows to about $170,000. And when your heirs inherit it, they receive a step up in cost basis, meaning they pay zero capital gains tax on all that appreciation. Total to your heirs in Scenario B, $603,000 plus $170,000. That's $773,000. Scenario A and Scenario B are almost identical on paper, a difference of roughly $1,000 after 20 years, which means the pay from outside advantage essentially cancels itself out once you account for the growth you gave up and the step up your heirs lose. I used to give the standard advice until I ran this exact comparison for a client. I was wrong. The pay from outside rule is not universal. And once you factor in what those assets were worth to your heirs, the supposed savings often disappear. Now add state taxes. In California, capital gains are not taxed at a favorable rate. They are taxed as ordinary income, with a top state rate of 13.3%. Combine that with the federal rate, and you're looking at a total rate closer to 28%. At that combined rate, paying from outside doesn't just lose its advantage, it becomes the more expensive option. You'd be paying more in taxes on the sale than you'd save by keeping the full $200,000 in the Roth. The framework that actually works is what I call the total wealth lens. Instead of comparing tax rates on a single transaction, you look at the after-tax value of everything you own over a 20-year horizon. Your Roth, your IRA, your taxable account, and what passes to your family. That full picture is where the real answer lives. So if paying from outside isn't always better, what does the smart path look like? It starts with a multi-year conversion approach that doesn't force you to liquidate your best assets to fund a single year's tax bill. Once you see the full picture, there are two very different ways this plays out for an IRA millionaire. The first path is following the standard advice, without thinking about what's actually in your taxable account. You do the conversion, you sell appreciated assets to cover the tax bill, and you do it again the following year. Over time, you chip away at a portfolio you've spent decades building. The future growth on those shares is gone. In a high tax state, the capital gains taxes eat into the savings before you even start, and your heirs inherit a Roth with no taxable account beside it. The second path is slower, but it preserves more. Instead of selling taxable assets, you design a multi-year conversion ladder. You convert only enough each year to fill your tax bracket, say $25,000 per year over 10 years. You fund the tax bill from IRA dividends, small required minimum distributions once they start, or low basis cash positions rather than appreciated stock. The taxable account sits untouched. Your heirs eventually inherit it with a stepped-up basis, and the Roth keeps growing tax-free on the side. Here's a simple projection. Say you have a $1,200,000 IRA and $50,000 in a taxable account with a low-cost basis. Instead of a large one-time conversion funded by selling that account, you convert $25,000 a year for 10 years. By the end of that period, $250,000 has moved from the IRA into a Roth. The IRA balance has come down, which reduces your future required minimum distributions and the ordinary income taxes attached to them. The taxable account is still intact and still compounding. One example from financial media shows a 62-year-old converting $100,000 per year from a $1,800,000 IRA, paying $120,000 in taxes over 5 years, with a break-even point of around 13 to 14 years. That example assumes paying the taxes from outside. If the taxable account holds low basis assets, the break-even stretches further, or the math never works out at all. The latter approach doesn't eliminate taxes, but it gives you control over which assets absorb the cost. So what do you actually do with this? Here are 3 concrete steps. Step 1. Audit your taxable account before you decide anything. Pull up your most recent brokerage statement or the Form 1099-B from last tax season. Look at the cost basis for your largest holdings. If the cost basis is less than 30% of the current value, you have a low basis position. Selling it to pay conversion taxes is probably a bad idea, not just because of the capital gains bill today, but because of the future growth and the step up your heirs would have received. If the cost basis is high, say above 70%, the math on paying from outside starts to look a lot more reasonable. The basis number is the single most important piece of data you need before deciding how to fund your conversion. Step 2. Run the full comparison, not just the rate comparison. Take 3 options and estimate where you end up in 20 years. Option A, you pay the conversion taxes by selling taxable assets. What lands in the Roth, what remains in the taxable account, and what does your IRA look like after required minimum distributions over that period? Option B, you withhold from the IRA. Less goes into the Roth, but the taxable account grows untouched and passes to heirs with a step up. Option C, you do nothing. The IRA keeps growing, required minimum distributions push income higher each year, and your heirs inherit the IRA under the 10-year rule, which requires them to empty it within a decade and pay ordinary income tax on every dollar. A basic spreadsheet with a 20-year horizon and a 7% growth assumption will show you which path preserves the most wealth across your whole portfolio. Most people have never run this comparison. Most advice stops at the rate difference. Step 3. Use the safe harbor rule to avoid penalties. If you do a large conversion, you'll owe taxes on it, and you'll need to pay estimated taxes during the year rather than waiting until April. The safe harbor rule protects you from underpayment penalties. If your adjusted gross income is above $150,000, you need to pay at least 110% of your prior year's total federal tax in estimated payments, and you avoid the penalty. This is one of those details that catches people off guard, especially in their first year of doing conversions. Plan for it ahead of time. One more thing that stops a lot of people at this stage, the fear of paying taxes now. I don't want to send the IRS money today for a benefit I might not live to see. That feeling is real, and it's worth taking seriously. Let me address it directly. There's a reason so many people with million-dollar IRAs still haven't done a single Roth conversion. It's not ignorance. It's a feeling most people don't talk about out loud. Selling stock you've held for 15 years is uncomfortable in a way that's hard to explain. Psychologists call it the endowment effect. We assign more value to things we own than to things we don't yet own, even when the numbers say they're equivalent. That stock you bought decades ago isn't just a financial asset. It carries history. It represents decisions that turned out right. Selling it feels like a loss, even if you're reinvesting the proceeds somewhere sensible. On top of that, the complexity of the conversion decision creates what's called paralysis by analysis. There are too many variables: tax rates, state taxes, cost basis, heir planning, break-even timelines. When something feels this complicated, the safest feeling move is to do nothing. But doing nothing has a cost too. Every year you delay, the IRA grows, the future required minimum distributions grow, and the tax exposure your heirs face grows. I've been there too. I held on to a stock for 15 years because I couldn't bring myself to sell it. When I finally ran the numbers, I realized it was a better decision to leave the stock untouched and do smaller, IRA-funded conversions over several years. Not the dramatic move, just a steady, boring process that kept my portfolio intact. The reframe that tends to help people get unstuck is this. You're not asking, should I sell? You're asking, where do I want future growth to happen? In a taxable account where gains get taxed along the way, or in a Roth where growth is tax-free for the rest of your life and your family's? That's a different question, and it usually has a clearer answer. Here's the one rule worth remembering from all of this. There is no universal answer to how you should pay Roth conversion taxes. The right answer depends on what's in your taxable account, what state you live in, what your heirs will owe on what you leave behind, and what the total picture looks like over 20 years, not just this year's tax bill. The standard pay from outside advice is a reasonable default if you have cash or high basis assets sitting in a brokerage account. But for IRA millionaires with appreciated positions, it's often the wrong move. The rate difference that makes the strategy look attractive on a whiteboard disappears once you run the full numbers. The goal isn't to pay less tax this year. The goal is to keep more wealth in your hands and in your family's hands over the long run. That's a different target, and it requires a different analysis. If you're working through your own IRA conversion strategy and want more of this kind of breakdown, subscribe to the channel. I cover the real numbers behind retirement decisions so you can make better ones.